Welcome to the Cash Flow Academy podcast. This is where we make investing fun, simple, and real. And I'll tell you, I'm giddy. I'm like a little kid. We have Dr. John Cochrane in the house today, which he's just a powerhouse. You don't look grumpy to me. You look pretty happy. You know, people ask me, Andy, do you subscribe to stuff? I don't subscribe to a lot. The Journal, and I have one or two people I will invest in to hear what they say. The Grumpy Economist is one of those. So that's a great blog. Interesting stuff on that you blogged. You did an op-ed in the Wall Street Journal recently on some of the ideas that Trump has. So we'll get into that maybe. But really, can't wait. Like and subscribe. Hit your notification bell. Drop by our website. Make sure you cashflowbonus.com for free stuff. But Dr. John Cochrane, thank you for being on the program.
Pleasure to be here. Thank you for that warm introduction.
Well, if you wouldn't mind giving people a little bit of your background, it's extensive. I joke with my audience all the time that I was the worst player in the history of the University of Utah, and I just trying to stay eligible. And this is as close as I'll get to Stanford. In fact, if they find out that you're talking to me, you that could really hurt you. So
that's wrong. We like to talk to smart people everywhere. I'm really boring. I spent most of my life at the University of Chicago, and then I got a call from Hoover Institution. I moved out to California, and I spend my life thinking about money, inflation, stock prices, recessions, and all the crazy things that come out of Washington. It's a great life.
Oh, it's fantastic. You have a book which I think is people should not shy away from, if they see an equation, they see an epsilon or something, they run for the hills. But I will tell you, if you can understand, when I taught my sons financial education, I pulled them out of school for a year between 8th and ninth grade. We took a gap year and I taught them financial education because I don't think the schools do it right. And I started with them by removing all of the numbers from a financial statement. I just used arrows so they could see how cash flowed through it. And you can learn that conceptually with children before they even put a number in there. And if people can pick up a copy, I love this book, The Fiscal Theory of Price Level. And I have a little empathy with you because I wrote a book on 401ks, and my wife says, Andy, no one wants to curl up by the fire and read a book on 401ks. So, our genre of writing is a little different. But I will tell people, buy that book. That is in your library. Absolutely need to understand. So we'll talk a little about that. You've also co-authored the Crisis Cycle, Challenges, Evolution, and Future of the Euro. We're going to talk about both of those things, and hopefully we land by the time we're done a little bit about today and what this means to our listeners. So with that, you were very brief in your own introduction. I think people will know who you are if they Google a little bit. You're a big deal. I'll just say that.
That's sweet of you.
Let's talk about this fiscal theory and price level. There are people in the Keynesian camp, and the truth is somewhere in the middle, I think, where they'll say, well, you just go to Jerome Powell and you say, fix this stuff. If we have inflation, fix it. If we have unemployment, fix it. And you have this steering wheel where you have knobs and levers you can pull to steer things. That's kind of the Keynesian camp. Austrian camp says, hey, let the thing alone and hope it corrects itself. I don't know. If I was smart, I'd be at Stanford talking about this. But what I think is really interesting that you bring to the table is, would you just talk briefly about what fiscal theory of price level is and how difficult it really is to untether monetary policy from fiscal?
I'd be delighted. It's what I love to talk about. But don't be afraid of equations. So equations are what we use to convince each other that it's right. Also, I have a website. If you look up johnhcochrane.com, the fiscal theory part, there's all sorts of essays designed for the regular reader to understand how it works without the equations. The equations don't mean it's right, but among economists, if you can't write equations, we know it's wrong.
Right, right.
So it's a reassurance, but you don't have to plow through them. The basic idea is really simple, that in the end, inflation comes when the government prints too much money or too much government debt, then people think it's going to be able to repay. So in the end, printing money to finance deficits, that's where inflation comes from. A loss of faith in the government debt is where inflation comes from. When we try to get rid of government debt and buy other stuff, we drive up the prices of the other stuff. Fiscal theory recognizes that money is, especially today, just another form of government debt. So that fundamentally, we're using government debt to make our transactions. It's how many bits of government debt do I give you for a cup of coffee? And if people don't think that government debt's valuable, then it becomes less valuable and we get more inflation. And if you look through history, almost all of the big inflations came when there were times of trouble with government finances, like 2021, 2022, when our government ran unbelievable 25% of GDP deficits, ran up $5 trillion of extra debt. No particular plan on how we're going to pay it back. People went out, try to spend it, up go prices. It's not a big mystery. All the mysteries are in the other theories. This one is what your grandmother told you about how things are going to work.
There's so many reasons for people to purchase fiscal theory of the price level. If you're an investor, it's really important to understand how the big tide can what's happening there. But also as a consumer and as a member of the electorate, to understand, I think about people going into a voting booth and not understanding this stuff. I think we do better if we taught this more in school, and it'd be a lot better. Let me throw this out at you. We have this faith, and in 1971 we pull the dollar off the gold standard, and we say, well, now it's the full faith and credit of the United States. And what you just said, I agree with wholeheartedly. That I'm really saying, okay, do I believe in the United States production economy and their power to tax? And do I believe those surpluses, which we haven't heard that since the Clinton years, but we believe those surpluses, can balance out those promises we've made. And like you say, I have a shopping cart, and I have a price for that, and there is a correlation between what I believe in the future. That's my full faith and confidence. So let's say that we run up a bunch of government debt, and the Fed decides to raise rates to fight inflation. Well, if I have a bunch of treasuries that are maturing, and maybe those treasuries are at, 2%, 1 point something percent, and now I've got to swap those out, basically. I've got to cover those, so I've got to borrow more money, kind of a Ponzi idea. I've got to borrow this money at 6 or 5 to service this old debt that's 2 or 3. That's got to put an extreme drag and cause problems. Could you talk a little bit about how difficult it is to deal with that 20? Where we rose all these prices, or rose the interest rate. The Fed does to fight inflation, but see that, according to fiscal theory and price level, that would exacerbate inflation because now your debt has increased. Yes.
Yeah. So even in the fiscal theory of the price level, the Fed is important. And I think it just reinforces a very old wisdom that you can read in my heroes, Tom Sargent, Bob Lucas, and down through the ages, through the centuries, we've understood that both monetary and fiscal policy need to work together to control inflation. It's not like the Fed is unimportant. But just what the Fed's interest rate machinations do to inflation is in fact much less certain than Fed officials and everyone else likes to say. It's portrayed as the thing we've understood perfectly since the 1950s. In fact, it's much less well understood than that. And so there's a bunch of mechanisms. One is, higher interest rates. We think that lowers demand and, lowers pressure on prices. But then there's a contrary influence. I think the one you just pointed out, and the one that's really in the news right now. If the Fed raises interest rates, that raises the interest costs on debt for the U.S., and the government has to raise taxes or cut spending to pay those interest costs. That is in footnotes of every mathematical model of how the Fed controls the economy with interest rates. And you got to worry about that one these days because, 1% higher interest rate is 1% of GDP more deficit. Are we really going to get that fiscal support for monetary policy? Good question. So the Fed's power is questionable in an era. Recognize how different it is right now. All our historical experience was with relatively low debt. Even in 1980, when the last big Fed move to contain inflation, debt to GDP was 25%. Now it's 100%. So those constraints on monetary policy make a lot of historical experience less relevant. The historical experience of wars, when we always have inflation and we always have big deficits, that might be more relevant. I want to say one more thing before you move on, because you just started in the sensible end of the pool. But there's so much nonsense. I just want to call out how much nonsense there is and guard your listeners against nonsense. Because when inflation comes, the first thing the politicians do is they say, oh, it's greed, it's price gouging, it's supply chains, it's shocks, we don't know, the dog ate my homework. It's the middlemen, the evil people, the hoarders, the speculators. That's what Emperor Diocletian said in the year 300 when he got a big inflation. And they round up the usual suspects. Now, what's wrong with that? Those are all stories, even if they're true, about one price versus another. They're not stories about the overall level of prices. So number one, do not confuse one price versus another with the overall level of prices. Inflation is not about, oh, bread went up, but gas went down, but airlines went up. No, it's not about the sum of prices. It's about the level of all prices, fundamentally the value of money. So that always comes down to the sensible end of the pool, where we're debating about the Fed, monetary policy, fiscal policy, and so forth. But that is what inflation is really about.
Well, when you take on the debt, there's I wouldn't say it's a permanence, but you take on a lot of debt. Even there's a feeling in a normal household, and I think that's why a lot of people start at the sensible end of the pool, because in my normal household or in my business, I have to be responsible with my finances. I don't get a print, and I don't get to decide what my credit limit is. So, there's this sense. You have the Warren Moslers of the world and Stephanie Keltons who say, and even Alan Greenspan, when they dropped the credit rating in the United States first time, Greenspan comes on and says, that's ludicrous. We can pay any debt we have because we can print money to do it. What I think people would find fascinating if they think about it, let's say I'm a member bank, and I've got a bunch of money. I put it at the Fed, and I get an interest rate. Well, that's a debt to the Fed. I mean, when you place money in your bank account as a savings account, that's a debt to the bank. And a treasury is a debt. It's the same thing, and it's the same faith and confidence. The only difference is if I'm going to buy a treasury, I've got a 30-year risk, and if I'm going to do a reverse repo, I got a 24-hour risk. But whatever the Fed says, that's the floor. We're the world's reserve currency, that's the floor. But it's the same debt. Whether I'm saving money with the Fed or I'm borrowing money from the government, it's the same debt. And people's confidence in that has to be tied still to future surpluses that might be possible or not possible. Yes?
Absolutely. So you make two really good points that I'm just going to say over again. One, the MMTers had some things right and some things wrong. Yes, our government can always technically repay debt by printing money to pay back the debt. But then if you print lots of money that people don't want to hold because it doesn't pay interest, then you get inflation. And then they said, well, we won't worry about that, but just print the money, hand it out, borrow money, hand it out, and we'll all be rich. Well, we did exactly what they asked. You can't ask for a better controlled experiment in economics. They said, borrow $5 trillion, print a bunch of money, send people checks, we'll all be rich. We borrowed $5 trillion, we sent people money, we gave them checks, and we got 10% inflation. And then they kind of said, well, we need price controls now. Oh yeah, thanks, guys.
It's pretty
the other thing,
crazy.
The other thing you mentioned is a very important thing to understand. The Fed is just a giant money market fund. Its money is just shares in a big federal money market fund. It buys treasury debt. It issues shares that trade at $1 per share and that pay interest, exactly like a money market fund, which is both good and bad. I mean, that kind of tells you how important is quantitative easing. I mean, does it really matter if you hold treasuries in a private money market fund or in a public money market fund? I don't know. But that tells you why reserves at the Fed are just a different form of government debt. They shorten the maturity structure. Yes, the Fed bought back some long-term debt and issued us short-term debt. And it takes a real nerd like me to get excited at 2 o'clock in the morning about the maturity structure of government debt. But that is an interesting question, but it's a different order of magnitude than, we're dumping a lot of stuff out that we don't know how to pay back. That's order. Okay, so thank you.
No, I think it's hard for people to understand the risk of devaluation of a currency, because the MMTers are going to say, look, we can print it. I mean, Warren Morsler made his career off Spanish bonds, saying, look, we'll print money to pay him off. That's how he made his, stuck his claim. But what I think is that people don't understand is, if you take a Sharpe ratio where you say, I want to know how much money I stand to make per unit of risk. I want to know if the risk I'm taking could be massive and I'm getting a return here. And so if you come out and you have, I think it was Fitch most recently, and then before Standard & Poor's say, we see you guys bickering in Congress over debt ceilings. That's a risk. So we're going to, you're so divided politically, we're going to drop the credit rating from AAA to AA+. Well, now you're supposed to take a Sharpe ratio and compare a risk-free rate. Well, if you're not AAA, you cannot be risk-free. So would you comment on that idea? Because treasuries are kind of where the world goes through for the quote-unquote safest. But if you drop a credit rating, they're not risk-free. I mean, they are, because you can print money to pay them off, but they're not at the same time. Can you unravel that puzzle for me?
Oh, yeah. This will be fun. In fact, the U.S. has a lot of legal structures designed to stop the government from printing money to pay off debt. The Treasury, and the Fed are separate. The Treasury is not allowed to print money to pay off its debt. It has to go ask the Fed, which is an independent agency, and so forth. And that's really important. When you buy a stock or a bond, you want to see some commitment that they're going to pay the dividends or pay the coupons. And that's part of the U.S. government's commitment that outside of unusual circumstances, we're going to pay you back in real money. We're not going to pay you back in funny money. Now, the credit rating on the U.S. debt, I think we need to distinguish technical default from real serious Argentina-style default, and the distinction between default and inflation. So those are three important distinctions I'm going to make. I think there is quite a worry, much more than people say, about, in a debt ceiling situation, a technical default on U.S. government debt, meaning that they would stop paying interest and principal while the debt ceiling's going on or while the government's shut down. And then 3 months later, you get it all back in the end. So from a long-term investor's point of view, that's not a disaster. From a financial market point of view, that might well be a disaster. We don't know what happens. Treasury debt's used in high-frequency financial markets as collateral. What happens to the liquidity of government debt, to its usability as collateral if it's in technical default, that might be and I got to call out our leaders, because the U.S. government has the money. Even in a debt ceiling circumstance, they could say, I am, the Treasury Secretary could say, I'm sitting in the office of Alexander Hamilton. I'm paying off principal and interest on Treasury debt before anything else because our reputation is sacrosanct, and we don't do that. No, they've been, past Treasury Secretaries have been willing to play the game of, well, I don't know, maybe Social Security is more important. Who knows about the fat cats, whether they need their money back. That's really, but that's, so that's my view, that it is a technical default where you get your money back after about 3 months and there's financial market chaos, is I think that's what the AAA ratings are worried about. Now, the bigger default is a Greek-style default, an Argentina-style default, which is always, it's phrased as a restructuring. It's not like you don't get your money back, but these short-term treasuries that you're rolling over, You don't get money back for the short-term treasuries. We're going to roll them into 2% 30-year bonds, and the interest is going to start in 5 years. Sorry, you got to wait for your money. But that's, you're not getting
That's
back
restructuring. Yeah.
what you promised. So you're going to get some sense on the dollar, or you're going to get, you might get a special tax on treasury holdings, which is the same as we're not giving you back the money you
Your
want,
money.
or you might be forced to hold them. Financial repression, those are the kind of things governments do in bad times. That is, one step further down the chain, and that happens if we get into some sort of a debt crisis situation. But that's less likely, but much more damaging to investors. And of course, from a long-term investor point of view, inflation is the same thing as default. We just had a default. We had, you lost about 20% of the value of your treasury
Yeah.
bonds in the cumulative inflation. So we did that. And, some economists say that was good. We wanted to pay for the COVID spending. We don't want to raise taxes to do it. So, we'll take it out of the bondholders. And the easiest way to do that is to inflate. So over history, inflation has been the preferred way for governments to default on their debt, meaning we're not paying you back the full amount we promised. And by the way, the U.S. has defaulted explicitly before. In 1933, the debt promised we will pay you back in gold. And they said, no, we're not paying you back in gold.
Yep.
And the Supreme Court said, ooh, that's terrible. It's a default, but constitutionally, you're allowed to default. So now there's some argument that was a good thing to do, but technically, it can happen that the U.S. government defaults. And state governments have defaulted on debts. National governments have defaulted on debts before. Anything bad that can happen in the world can happen here. That's part of the lesson. Okay, thank you.
So this is really important. I'm gonna plant a little flag here because we're gonna come back to this at the end. I remember when I was I was a teenager. I can't remember how old I was when Ross Perot ran, but he used to have those little flashcards and say, remember when the dollar was worth a dollar? And we were like, 3 trillion or something, 2 trillion. He was beside himself. Now we're at 37, 38, but also we have promised money as well as borrowed money. The off-balance sheet commitments, whatever you want to call it, unfunded liabilities. I don't know who to trust on that number because I've heard 150 trillion, 200 trillion. The piece of the fiscal pie that is about income stability, Medicare, Medicaid, Social Security, pensions is a huge part of that pie, and that's not in the 37 trillion. I think people need to understand that there's a big number of promised money, which is different and distinct from what I would call borrowed money. I want to plant those flags of those weigh, if I look at fiscal theory of price level, those future commitments weigh against our ability to have a future surplus, if that makes sense. So to me, that would point to even greater inflation, which then again exacerbates the size of those promises in the future. I just want to plant that flag there to say these are unsustainable in my opinion. Fair to say?
Flag planted, and you got plenty of company. Every Congressional Budget Office review of the long-term fiscal situation says unsustainable. And the one thing we know about unsustainable is it's not going to happen. The only question is, how is it not going to happen? Now, I think of the unfunded liabilities, the Social Security, medical, along with the other rat holes into which our government spends money. I mean, Washington still thinks it's like a money tree, and the solution to any problem is a couple $100 billion sent out to voters. There is a big difference, though, between that and Treasury debt. If Congress wakes up some days, you know what, we got to reform Social Security. We're going to index it to prices, not wages. You're not going to get the increases you thought. All the sense, you have to work a little longer. All the sensible things that we can do in about 5 minutes to fix Social Security. That is not a default on a debt. That doesn't trigger all the legal problems that actual default triggers. So I think it's just promises of spending that we know they won't keep, and the only question is, when will they keep, or promises? They've made promises to taxpayers that they might not keep either. But those will change. And
that's a key point
sooner
you
or
made.
later. The other thing to worry about. So one thing to worry about is these long-term liabilities. I think there's 3 threats to the budget. One is these long-term things, which got to change sooner or later. The other is this other off-balance sheet commitments. Through Fannie and Freddie, the federal government has guaranteed every single house in the United States.
Yeah.
And all the financial regulation nightmare, the too big to fail banks are all still, courtesy of Uncle Sam. So we made a lot of explicit and implicit promises to bail people out. And in bad times, that's going to cost a lot of money too.
Those are great points, and the Fed put does not deter these guys. I mean, when you think about TARP, which was whether it was troubled or toxic, I don't know which it was, but if you have troubled assets, can you imagine me as a business as I buy some crappy assets, and the government will give me cash for those assets? I mean, that's incredible. If you just look at my balance sheet that is horrible, my asset column is dying, and all of a sudden they say, "Oh, here, we'll buy those from you and replace with cash." To me, that's not a capitalist idea. Too big to fail in capitalism. You kind of got to let people fail, or they'll be pretty aggressive. But
Well,
we could go down that rabbit.
There's a narrow
Go
problem
ahead.
of how do you solve runs on banks, which we can get to how do you solve that separate. But that has morphed into the view that it is a systemic financial danger if anybody anywhere loses some money on a mark-to-market basis. And I was most scandalized in 2020 when the Fed said they issued a Mario Draghi worthy, the price of corporate bonds shall not fall. Really? Secondary market prices of corporate bonds falling is now systemic risk. And what that does is if you were the kind of investor that we love in America, that we should be giving gold stars to, namely someone who keeps some cash around, who keeps some balance sheet space around, who issues a little more equity than the absolute minimum the Fed says they have, so that when the downturn comes, you can buy the dips, you can provide liquidity, which is a very, patriotic thing to do. You can help prop up those prices. You can be the one who doesn't panic while everybody else is panicking. And, you're going to make some money, obviously, but you're also going to keep markets going. You're a fool because they're going to front run you anytime prices go down. So it's not just a huge waste of taxpayers' money. It makes the financial system much more fragile and therefore needs more bailout next time around. So we're on this spiraling bigger and bigger, and anybody who is going to contribute privately to this is made a fool of time and time again. They learn their lesson.
I think you just described very well, though, possibly a lot of those boxes you just listed are Warren Buffett checks. A little bit of cash on the balance sheet, able to buy the dip with confidence, come to the rescue when you need to, and pick up some stuff on sale. It almost sounds, to me, it sounds a lot like Buffett that you described right there.
We should love the Warren Buffetts of the world. But, the first time
Yeah.
around, when Long-Term Capital went under, he went in with a nice, cheap bargain basement Walmart offer, and the government front ran him and said, no,
Yeah.
we're going to give you more out of the taxpayers' money. Why? And now thanks for, well, we need more Warren Buffetts.
Yeah, we
And
do.
anytime markets go, when the treasury markets went nuts and the Fed stepped in, well, where are the hedge funds? Well, where are the Warren Buffetts who should jump in on treasury spreads? Well, they're not there precisely because they know the Fed's going to jump in.
If I could go to a casino and I knew my uncle Jerome was going to take out any losses that I had, I'd bet big as well. Let's
And it's the
shift
Treasury
gears.
too. It's not just the Fed. The
Well-
Fed lends money into special purpose vehicles that then buy the assets. The Treasury takes the credit risk. So in fact, it's your buddy. Well, I don't want to call it your buddy Steve because he hasn't done one yet. But we'll see what happens in the next crisis.
Well, you called out leaders. I guess I shouldn't jump on that bandwagon too hard, but I thought it was funny that Janet Yellen, this isn't the most recent shutdown, but the big one before where they really went to the 11th hour to raise the debt ceiling, she comes out and says, if you don't do this, it's going to be catastrophic, is the word she used, catastrophic. So then they raise it, and Fitch looks at it and says, that debate, those guys have enough vitriol that they might just let stuff out of stubbornness fall. So Fitch drops the credit rating, and then she comes out immediately and says, "Oh, this is ridiculous. We're not going to ever have any problems." Within a month.
I know Janet well, and she's a very nice lady, but I think she made a big mistake there, and the mistake was to play politics with the faith and credit of the United States. She could have said, I don't care what happens with these things. We're paying interest and principal on the Treasury debt. I want to calm the waters. Let these guys slug it out, but
Yep.
we are not going to threaten this. Instead, she kind of threatened nuclear war. She said, well, chaos might happen, and we'll let it happen if you guys don't give in and start spending. The Fed wasn't that clear either. The Fed could say, looking at a debt, a formal default, well, maybe the Treasury doesn't come through and do what they're supposed to do, but we will buy. You can
Yeah.
we will buy Treasury
We'll
debt
buy
at
your
par.
treasuries.
We will let you borrow against Treasuries, even if
Yep.
they're in default. We will not let a liquidity crunch happen if there's a technical default in the market. And the Fed didn't say that either. They were kind of using there might be, chaos here. You guys better, muscle in and pass this debt ceiling. Those are, I think those are, I think the long run faith in U.S. institutions is worth a lot more than winning this week's debt ceiling battle.
Let's transition with that flag planted, that the general idea that debt and deficits do matter and they are unsustainable, that we just don't know how it might play out. Let's shift to Europe. I think this is fantastic. You've written a book called Crisis Cycle, Challenges, Evolution, the Future of the Euro. So this is really interesting because if debt is an anchor, or if things are tethered to that, and Greece is a great example. So Greece is hugely socialist. They have, a lot of government employees, a lot of government dependency. And then you look at an economic powerhouse like Germany, who probably hasn't forgotten the Weimar Republic from their great-grandparents telling those stories. And so here you have a single monetary policy divided amongst however many members of the EU are. I don't know, 30? I don't know how many there are. I should know that. But there's all these...
22, but of the European Monetary Union. Anyway,
yeah,
there's a number we should both know.
you have this fragmented fiscal policy of every different type of congressional battle that can go on. And then you're trying to keep a blanket monetary policy. Can you I know you've written a whole book on this, it's 300 pages, but can you try to distill that challenge of keeping the euro intact?
Absolutely.
when you have this fiscal theory price level that says debt matters, and that monetary and fiscal are related, the euro it's a really interesting problem.
Yeah, so we're fans of the euro, just to be clear, and we want to fix it. The euro is a monetary union without fiscal or political union, and that's perfectly possible. There's no reason that we have to be politically or fiscally united to use the same money. In the same way, we can all use the meter if we chose to. We don't have to have fiscal and political union with Europe to use the meter. The money is just the standard that we use to measure the value of goods. And Europe they had a monetary union without fiscal and political union for 1,000 years. They used gold coins and they circulated internationally, and God knows they didn't have fiscal and political union. They were busy fighting wars with each other for the whole 1,000 years. So that's perfectly possible. But if you do, the rule is, if you're using a currency union, then you cannot count on we get in trouble and we can inflate away our debts. You've now committed to paying off your debts in someone else's money, in much the same way in the old days under the gold standard. A country under the gold standard is committing, we'll pay you back in gold. We've given up the right to just inflate away the debt. And it works the same way. I think actually Greece joined the European Monetary Union for a reason, and it was a very healthy one. By joining the EMU, the Greece commits, we're either going to pay back our debts or default, which will be very costly to us. So we're more likely to pay them back rather than what they did time and time again beforehand. Oh, crisis, devalue the drachma, inflate some more. And then people are saying, great, now that we're going to get paid back, we're willing to lend you money at absurdly low rates. That was all wonderful. Pre-committing a small, not very institutionally stable government, pre-committing that they're going to pay back their debts or suffer the big pain of default, lets them borrow more at low rates. if only Greece had invested that money in its economy rather than buying Porsches and the other things
Yeah.
they did, subsidizing
Yeah.
government workers, it would have turned out great. That was the problem, not monetary union. It was actually very beneficial for Greece. Then, when they couldn't pay back their debts, they found out about those those costs of default. So let me just try to be quick here. If you have a currency union without a fiscal or monetary union, then sovereign debts have to be like corporate debts. When you can't pay them back, you default. And there's nothing wrong with that. Countries, Greece isn't that. Tesla is probably bigger than Greece. Greek sovereign debt defaulting isn't a catastrophe. Sovereigns have defaulted for thousands of years. But you have to set up the system so that when a sovereign borrows too much, gets into trouble, they can't just call up the ECB, boop, 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 boop. Hey, print some euros, bail us out. They have to default. And they set the system up pretty darn well. An independent central bank that wasn't going to buy sovereign debts, debt and deficit limits, no bailouts across states. Guys, to join this, you got to pay back your debts. But, then crisis came, and all those
Voices come.
got broken. Yeah, and just the most important problem is they never were really able to say out loud, in the end, if you can't pay back your debts, you got to default. As a result, bank regulation treats sovereign bonds as risk-free throughout Europe. If you're a Greek bank and you borrow money from the ECB and buy Greek government bonds, you carry zero risk weight on that. So what do? They load up on the debt.
Sure.
And here's the problem now. A sovereign default, if Greece defaults, big deal. Somebody loses some money somewhere, goes home, kicks the dog, has a whiskey. But no, now what happens if the countries go under, then all the banks go under. So banks are hostages against sovereign default. So you can see now that I've said the problem, it's obvious what the solutions are. Get the sovereign risk out of the banks, treat it as risky, and ECB's got to stop bailing everybody out all the time, and we'll be back to a great euro.
I might get this wrong because my memory isn't as good, but I seem to remember in my study that originally when they said let's have a euro, it'll help all this. We live in a place where you can drive a train over the border, and it'll just be better to lubricate things and get things going with this exchange rates. Let's just have a euro. We're all here. Okay, great. But I remember, I think, joining that in order to qualify, you had to have a debt to GDP of like 60, 66, something like that. And so then it goes to 100, and then all those voices come in. You said, that's the rule. It's got to be 66. Then it goes to 100. People are like, well, that's okay. Any thought on that?
Yeah, that was the first, the first breach of the rules. And it was France and Germany. It wasn't Greece. It was France and Germany. Said, this bad.
It'll be fine.
Now, and then that's the schizophrenia. If you say, look, sovereign debt is like corporate debt. In the end, it defaults. We don't bail it out. Then you can borrow as much as you want. 100%, 200% debt to GDP. I don't care, because if you can't pay it back, you're going to default. So the fact that they even had debt and deficit limits meant they were a little shaky on this business of, well, we're not going to bail you out. So you can see a little bit of the tension right there.
How does Japan, we had in World War II, our debt to GDP is in 150 or whatever it was.
Yep.
How does Japan have, sit there between 200 and 300 for decades and it's fine? Or is it really fine?
The what about Japan question.
No. I don't know. I don't know that I'd want to be Japan.
No. Well, first of all, Japan is suffering low growth, and that has to.
Yep.
That has nothing to do with monetary policy. Everyone says, oh, it's the Bank of Japan's fault. No, 30 years of low growth is about microeconomic, distortion, stagnation, and not having any babies. It's not.
Or immigration.
So Japan is the second thing to point, before we get deep into Japan. Even if Japan can get away with it, that doesn't mean Turkey, Argentina, UK, or US can get away with it. The rest of us seem to find around 100% debt to GDP. All of a sudden, the bond markets are saying, really, you? And we go, well, what about Japan? And
yeah, that's what they all say.
I don't want to talk about Japan. I want to talk about you, and we're not lending you anymore. So just even if it works for them, for some strange reason, that doesn't mean it works for you. Now, then there's a lot of reasons why Japan is getting away with it for now. The most important is anybody's debt, if the interest on the debt is minus 1%, any debt's sustainable. What the heck? They're paying you to borrow. If the interest rate goes up to 1, 2, 3, 4%, all of a sudden it's not sustainable. So
Yeah.
they are clearly in that range where at low interest rates, it's fine. At high interest rates, it's a problem. And so you're very vulnerable to a run, a speculative attack, or what do you want to call it? But then a couple good things are going about Japan. First of all, the net, it's not that much debt than you think. There's the net debt is much smaller. Japan has been running decades of trade surpluses. With that, they bought lots of foreign assets. So in fact, and my colleague Hanno Lustig at Stanford has a great paper on this. You look under the hood, and they've been running the world's biggest carry trade. They've been issuing very low interest rate Japanese yen debt and using it to buy U.S. stocks and bonds. They're salted away in
Yeah.
their pension funds, and the yen is slowly depreciating. So the carry trade is where you borrow in a cheap country and invest in a high interest rate country. The third thing about Japan is their debt is mostly long-term debt held via financial, like insurance companies and stuff, by old Japanese people. Our debt is short-term debt held by foreign central banks and other hot money. So what they can get away with, they can get away with that a lot longer than we can.
Great stuff. Let's transition now. I was going to try and do this in thirds, talk a little bit about fiscal theory of price level, a little bit about foreign, the euro. Let's talk about home. You did a blog and also an op-ed in the Wall Street Journal talking about some of Trump's stuff. Let's talk about two or three things here as we close out. First of all, if you say I'm going to raise revenue through tariffs, then if I look at that equation, I say, okay, on this side I have debt and I have prices, and on this side I have we'll just call the other part of the equation faith that we'll have surpluses to build confidence. Faith that the
and if I
economy
may,
will do well.
faith that sooner or later these jokers will not run the United States, the greatest country in the world, into a Latin American
Into the
debt
ground.
crisis. That they will do the simple reforms that we all know can be done. That surely that, why haven't bond markets revolted? Because they surely think this will happen, but that faith can evaporate. So I'm sorry, I just wanted to interject there.
Yeah, sure.
Faith
A big
faith
picture,
matters.
right? We're not going to be Venezuela, right? That's the
We hope.
faith.
We could be, but we hope, yes.
Well, Munger has said that actually. He says, who knows when money printing stops, and if you don't, you wind up with Venezuela. So with that said, President Trump says, all right, let's tariff. Why should we pay this out of our income taxes? Why should we tax corporations? Why should we tax anybody? We'll tax China. Who cares? They're going to move their plants to Vietnam anyway, and they're going to have parts all over the place come in. So on the one side of the ledger, you say, well, that'll raise revenues, right? That should be deflationary. That'll raise revenues. But if you go outside of that equation and say, yeah, but if they just pass the tariff on in higher prices, that's going to be inflationary. Thoughts on that?
That's good. It's going to be both. It's going to be higher prices. The tariffs get passed through. Whether it's overall inflation depends on the Fed, because again, that's a relative price. The imported goods go up relative to other stuff. The Fed could decide we'll let the other stuff go down. They're not going to. The Fed has already said we're going to do again exactly what we did in 2021. They think 2021 was the same, a supply shock, and they chose we could have this go up or that go down. Sorry, everything's going up. But they're going to look through the tariffs, is the way they call it, and let the price level rise and then stabilize, and we'll be a little bit poorer. But you're right, it has that inflationary effect, if you'd like. It makes some prices go up. I give this lecture on inflation isn't just prices, so I had to put that in. But it also does raise some revenue, a couple $100 billion. Now, the tariffs are an answer out in search of a question. There's always like 10 questions, and they keep jumping from one to the other. I think fundamentally, the most charitable view of thinking about the tariffs is they're not really economic policy, they're geostrategic policy. We're going to bash people over the head with tariffs until they do what we want. And
that's exactly the way I see it.
Whether it's working, we'll talk about on Geostrategy Day. But it's, aircraft carriers are expensive too. I mean, if I'm trying to be charitable to the Trump administration gets really beat down by economists. But if you view it as we're going to buy an aircraft carrier or we're going to pay the cost of tariffs, well, both of those are expensive, and let's see if you use them well geostrategically. As far as the revenue argument, though, it's not on its own a particularly strong argument, because Tariffs are a sales tax. It gets passed on to consumers eventually, and we're going to see more of that in the next year. So stuff's more expensive. Well, you're raising taxes, stuff's more expensive. It is paid by the U.S. That's, we are going to pay the same way we pay sales taxes. But it's an inefficient sales tax. I'm all for get rid of the income tax, raise all of government revenue from essentially a sales tax. That would be a much better tax system for 100 reasons. But the problem is only raising taxes on imports, then you're trying to get all the money out of a very small number of goods, and that creates all sorts of inefficiencies in the economy. And we economists hate inefficiencies.
Yeah, for sure. Here's the big one. So now let's talk about moving forward, and I'm going to throw out some amateur theories of mine, and hopefully you can shoot them down. I'd rather have someone tell me I'm wrong than tell me I'm right, because I want to know the truth. Because when you can be wrong, then that's helpful. AI is concentrating the wealth in the S&P. We've got a huge S&P, but it's concentrated amongst very few players, really. So there's this concentration of wealth there. If I look at gross domestic product and production, already even in my own business at the micro, ultra, and nano micro level, it's changing my business. I mean, I'm more efficient. I'm producing more. That's a key. Technology can help us produce more stuff. They're investing in nuclear. There's probably a bottleneck in power grid to where they'd like to be, but they're going to invest. They're going to build these data centers. They're going to go after quantum, and they're going to go after AI. So I see a huge shift. Let me give you an example. Salesforce. In the same week, Salesforce comes out and says, well, we're going to let go 4,000 people. So there's an unemployment. And that wave, if you talk to the engineers of the AI, say, well, the coders go first, but everyone will be touched. Robotics can do, it's just comparative advantage. It's not a question of if a robot can do my job now. They can see, think, and manipulate the environment. Those are the three things: perceive, cognize, manipulate the environment. So now it's really, is it better for me to build a kiosk than hire an order taker? Is it better to me to have a bipedal robot bus a table than hire a person to do it? Is it better for me to hire, all these low-level, mundane, intellectual labor jobs are at risk, in my opinion. Now, this is a long question. So Salesforce, in one thing, the CEO says, I need less heads. I'm not in economic trouble. We're not downsizing because we're having to adjust our balance sheet. I just don't need the heads. And in the same week, they said, well, now we've been approved for another 20-odd billion in buyback, which is a total of $50 billion in buyback. That's 20% of their float. That's 20% of the shares that you can no longer get as an investor. As you talk about confidence, and I'm talking Zimbabwe type of confidence, Argentina type of confidence, when you lose confidence in a currency, you're going to fly to what a dollar, gold, Bitcoin, whatever you think is there. I see an increase in buybacks and a decrease in labor. The reason people go work at a job is they see it as less risky as owning. In other words, we have labor or ownership. Well, Warren Buffett says, if you believe in American business and you seek out the lowest way to participate, which means ownership, right? I own Coca-Cola. I don't do anything, but I own it. I think that as people start to lose confidence in labor, almost like you'd lose confidence in a dollar or a currency, they would gain the confidence to own, because if I feel I could be replaced by AI, my alternative, I got to own the AI because I can't compete with it. I see that as a stock market surge like never before. And I'm a perma-bear, man. I'm bullish in my portfolio like everybody else is. But as soon as there's problem, the VIX goes through the roof, like everyone's ready to bolt. So here's my long-winded question. You have an arm wrestle between bulls and bears all the time. Sometimes the arms are big and sometimes they're small, but they can be static either way, right? I see a massive bearish arm in fiscal irresponsibility, massive debts, off-balance sheet commitments, unsustainable, horrible bullish stuff. I see this incredible, or bearish stuff. I see an incredible bullish arm with AI in the production, and they're locked right now. I don't know which one's going to win. I'm betting on ownership just because that's been my philosophy, is to own things rather than labor. But I'd like your thoughts on the consolidation of the wealth, the potential unemployment. Not everyone loses their job, but there's certainly going to be an effect by AI. And the creative destruction argument I don't think holds, because the creative destruction argument always says, well, you're going to need a human to do something above that. If we have a tractor and we get rid of farmers, well, we'll have more factory workers. Well, we get rid of the factory workers, well, we have more computer guys. But now, since you can replace a human, you might have hit the top of creative destruction where it shifts to comparative advantage. Unbelievably long-winded question, I know, but that's where my brain is right now. What do you think about the loss of confidence in labor and people finally saying, I'm going to risk ownership because I don't believe in labor?
So you asked a bunch of great questions.
I know,
here.
I know that's long-winded, but
so you asked, one question you asked is the financial side. So the financial side, let's attack that one easier. We've seen this before. A new technology, great new technology comes along. Railroads in the 1800s. The huge 1920s were like the decade of America. It's when we got radios, washing machines, television, phonograph, kind of the modern world, and huge investments in those. And like the railroads, prices went up, and then how can I make this polite, went down again.
Yeah.
The tech boom of the 1990s. Again, great technology. The internet is the defining thing of our lives, but valuations.
Tech is deflationary, right? My iPhone can do more now than it could in the 80s.
I'd like to think, rather than thinking in terms of inflation, deflation, which remembers the value of money, tech makes all sorts of things cheaper, like things that used to cost infinite and now cost a lot less.
Right.
So it was wonderful in terms of the real wealth and prosperity of Americans. So we're just replaying that again. So the valuations of the current AI companies look a little bit high to me. And high valuations tend to mean disappointing returns. We don't know exactly when, but there's a huge real investment going on in data centers and stuff, like the investment that went on in internet and fiber optic cable that turned out to be really useful last time around. So that seems like we're playing the same story again. It is quite possible. Now you're talking about the difference between government and AI. Stock investments, real estate investments are real things. So even if it's possible if the government blows up and then the real things continue to do well, even if there's a big inflation, stocks should protect you against inflation in the long run because they are, real wealth, unless the government drags them all down on their efforts to stop inflation and raise taxes. So it's perfectly possible to have that bit of schizophrenia. Now, the government going down, I think our fiscal dangers are less just if everything's quiet, it falls apart, as opposed to, what happens in the next crisis. But we've done enough of the fiscal dangers. You can have both views, that government debt's in trouble and AI is a good, or the stocks are a good or bad bet. So yeah, bottom line on the financial end, I think valuations are pretty high. Somebody's going to be disappointed. There will be a rout at some point, but huge investments going on in what is clearly
real investment.
The technology, real investments, useful investments. This is going to be great technology. Now, the other thing, we've also seen this one over and over again. Gutenberg invented the printing press. The monks will all be out of a job.
Yeah.
The railroads invented. The guys who drive horses will be all out of a job. The car is invented. So much for the buggy whip manufacturers. The word processors invented, and the Xerox machine. So much for all the typists who will now be out of a job. Over and over again, that has proved not to be true, and I think absolutely that's going to prove not to be true again.
Interesting.
You mentioned buybacks. So it's interesting that, Salesforce, first of all, at least according to this morning's Wall Street Journal, companies are kind of using that as an excuse to get rid of people they wanted to get rid of anyway. They are not currently using AI at such a scale that they actually can get rid of a lot of people. They're just getting rid of people that they hired too many of in the past. But it's interesting that a company like Salesforce, any company that's buying back stocks, is saying, look, I don't have any good investment opportunities internally. for this
Same
money.
as Berkshire. Yep.
I would have thought Salesforce, of all companies, would be plowing every cent of retained earnings plus every cent they can issue in new equity into AI-izing their shop to expand. What AI allows you to do, and we got to remember all this, it's not like there's a fixed output and that if I make it cheaper, I can
Right.
fire people and have a fixed output.
You could build your business with it.
Build the business. When the
Yeah.
ATM machines came in, everyone said, the bank
tellers are
will be
out.
out of business.
Yeah.
What happened? Banking expanded so much that overall employment expanded. Now, whether it's a good thing to have every branch trying to sell you overpriced high-fee financial services, I don't know. But that's oh, God. I walked into my local Chase Bank the other day.
Depends on if you own the bank.
Yeah, we want to sell you our 2% mutual funds. No, thank you. But anyway, they certainly expanded. And so, that's what we should expect the sales forces to be expanding their operations, because now a smaller number of people can do lots more high quality work. As costs go down, we buy more. Actually, on this principle, this is an elasticity question that economists love. What happens if the price of computing goes down from having to hire people who go 2 + 2 = 4 down to, right now the price of adding 2 + 2 has gone down to 0. Do we spend more on it or spend less on it? We're spending immensely more on it, right? Because the whole data centers, hundreds of billions of dollars going into the cheapest thing on the planet. Why? Because when it became cheap, we found uses for it. And so the expansion far overwhelmed the decreased cost. The number of things you had to add in 1945 could be done on one iPhone today. Well, the quantity expanded so much that we're spending way more on it. So that's the curious thing about Salesforce, is why are they giving money back to investors? Now, buybacks are not bad.
I love
buybacks. Are what a company does.
Concentrate the shares.
No. It doesn't really affect rates of return. It means the company, it's just like paying a dividend, but without paying taxes on the dividend.
Yes.
That's all. It means the company doesn't need the retained earnings, but that doesn't mean society as a whole isn't investing. The company is giving the money back to investors so they can turn around and plow it into another company that's building data centers or something useful. So it really is, it's an important, useful reallocation of capital. And everybody in Washington thinks, this is just giving money to the wealthy, to the whatever. No. It's redeploying from a company that doesn't have good investment projects to a company that does have good investment projects. The puzzle is that Salesforce, of all people, of all companies, you would think would have a great internal investment projects. So I think AI is going to be just like every other wonderful productivity enhancing investment. Yes, some people whose specialized skills they're going to lose. Just like, the weavers in the Industrial Revolution. The weavers lost out. They knew how to weave cloth and they didn't do so well, but their kids did much better than everybody else. And there's a reason you have a safety net, and there's a reason you have flexibility. And there's a reason we should all learn how to use AI. And so the world is going to be another great tool for human creativity. It's not going to be a few plutocrats own everything and the rest of us are out in the gutter begging for scraps. That hasn't happened over and over and over again since your ancestors and my ancestors were scratching out potatoes somewhere in Europe and earning about $100 a year. Well, look at our lives. That over and over and over again, we invent something that looks like it's going to destroy employment and make the plutocrats wealthy. Instead, we all get spectacularly better off. AI is another one.
It's going to be interesting to see how it plays out. I've been studying a lot of Dario Modier from Anthropic, and particularly Jeffrey Hinton from Google Brain, who quit. And he used that exact analogy you did with tellers. We just had the tellers do more interesting things. He actually thinks it's different. He says, what do you do when when the technology, he says, if you really understand what this can do, when you say, well, the humans will just do a higher level of stuff, he says that's going to be tough because you'll have guys in your pocket that are greater than the sum of human knowledge. It's like having Nobel laureates in your pocket. It's an interesting study. Okay, last thing.
But that's what's wonderful about it, especially for people who aren't Nobel laureates. People who
Yeah,
aren't Nobel laureates can have a Nobel laureate in your pocket. Think of
like me.
a nurse practitioner in Africa who,
Yeah,
has to go out and help people. Well, now on a cell phone, that nurse practitioner can operate at the level of, an A minus doctor in the U.S. That's fantastic.
it's
And that's
incredible.
who's gonna, that's, AI lets you benefit from all of human knowledge, but I think it's going to be a great tool for letting people in the middle who know how to use AI, but also know how to, what their business is and so forth, that they can then operate at a much higher level, and much higher level of productivity means higher wages.
And you make a great argument is, do you cut people, or do you try to do you cut 10x of your, or do you cut a tenth of your workforce, or do you try to 10x what your productivity is? That's a really good
Yeah,
question.
you might cut a tenth of your workforce and then hire another people who know how to use AI to provide the same
To
services,
get it
and
bigger.
then you expand into better and different services. Think what Salesforce could do if the cost of what they do goes way down. They could, be helping you and me run podcasts. I don't know
Already
what
are
they
in a
do.
way. Technology's been fun. Let's finish here. And you've been so gracious with your time. I'm a kid in a candy store right now. This is
Oh, that's
incredible.
sweet of you.
So let's talk about Chairman Powell a little bit. So their dual mandate is price stabilization and also employment. And it's really timely. I don't want to put on my tinfoil hat conspiracy. It's so easy to do that when you say, isn't that interesting that we had a government shutdown to where now we didn't have the ability to make the report for the unemployment numbers. So now we have no numbers because we couldn't pay the guy to get the numbers. And it's like, well, who planned that? Well, I don't know if there's any. I'm not a conspiracy guy. But it is interesting that he is driving now without data. It's going to take a while to catch up the data and figure out where we are. That's fine. Even so, we've had revisions of 1 million jobs recently. So tell me how you feel about where the Fed is as the fiscal irresponsibility grows, and I'll just call it what my opinion is. I think it is irresponsible. As that stuff grows and as the deficits grow, because Democrats and Republicans are becoming less distinct there. It's just what they want to spend the money on. They both want to print, right? I mean, I don't see as big a difference as I used to. Used to kind of have a fiscal conservative somewhere. There aren't any anymore that I see. People don't want to talk about off-balance sheet stuff. But that said, I think it makes tough. Are we approaching fiscal dominance? And is Jerome Powell's job getting really, really hard? They're lowering rates third time in a row. You've got a couple of people disagreeing. I don't think we've had this much disagreement in a while. What's your thought on the current status of the Fed today and their quagmire, if there is one?
Well, they are certainly between a rock and a hard place. When I look around, I tend not to be conspiracy type. But my go-to theory is always incompetence, not
Not sinister.
conspiratorial,
Yeah, not
devilish,
sinister.
not sinister action.
Ignorance rather than being sinister.
And
Yeah.
then weird chaos, institutional incompetence among very smart people, which is that's the story of the Fed. Each of the individuals that
That's
I
a great
know
way
is
to put it.
really smart. They understand things very well, but and the only problem with the Fed is it's the healthiest horse in the glue barn. It's you know it, it's except for it's the worst of all possible government institutions, except for all the other ones. And the Fed is actually, relative to everything else in the government, pretty darn well run. Um,
That's a
so
nice way to frame it.
no,
Relative to everyone else. That's a good way to frame it.
they're pretty well run. Um, you mentioned the data question, and I think there's this vision of the Fed understanding this jet engine like complexity machine, and how we got to get the absolute latest numbers on how many McDonald's servers there are in Iowa, and then we can calibrate whether the federal funds rate should be up or down 5 basis points. That is insane. I mean, just think to yourself, of all the things affecting how many people have jobs, where is the overnight federal funds rate in that list? Let's start with the fact that social programs take away $1 of benefits for every dollar you earn. Let's start with the educational system's a disaster. I mean, the overnight federal funds rate, And the idea that, without the latest month of employment, they're going to get this slightly wrong. Come on, guys. I think we need to focus on the bigger picture. The biggest one of all, of course, is I'm still old-fashioned. If the Fed just kept inflation under control, employment would take care of itself. At least as far as the Fed can control things. The big problems of employment are over at the Congress. So, good inflation data is important. But the big picture is this question right now. Trump wants lower interest rates, and one of the main reasons is to lower the interest costs on the debt. Yeah. Economists say, well, if you lower interest rates, inflation.
Yeah.
But then there's this other mechanism, and actually lowering interest costs on the debt makes it better. And I think the administration's case is a little bit optimistic. It's all the wonderful things that are going to come from tariffs and AI and so forth means that there will be, lots and lots of room for the economy to expand. So we'll take the lower rates now and the lower interest costs on the debt. And to be honest, you look at the evidence, how long does it take from lower interest rates to turn into inflation? This is what the U.S. did in World War II. The Fed was told, keep rates down because your job is to help fund this war, and we don't want to hear nothing about anything else. Inflation came, but it took quite a while. So, how long would it take for these low rates to cause inflation? It's an open issue. But I think the big question is exactly when inflation rears again, as it, I think, will. And it's clear that budget deficits are the problem. Does the Fed have the stomach, the gumption, the independence, and the mandate to say, no, we're not doing this again? In the next crisis, it'll be exactly like 2020, 2022. The government will say, we want $5 trillion to bail everybody out and stimulus, and this time probably to buy an army, because that's the kind of crisis we'll be talking about. Yep. And bond markets are going to be going, are you kidding? What did you do to us last time? And then it'll be the government calls up the Fed and says, beep, 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 Fed, we need you to buy all those treasuries and we need you to hold down interest rates. And the result will be even quicker inflation because everyone's primed. They saw this happen once before. So does the Fed have the gumption to say, no, we're going to let those interest rates go up and you guys got to figure out where you buy it? Or does the Fed say, we're going to cave this once again? That's really the issue for the Fed going forward. And in the short run, as interest costs on the debt mount, can the Fed, raise interest rates a little bit, knowing that each rise in the interest rate is another 1% of the 1% on the deficit. I think that's going to be the fight going forward. That is the rock to hard place that no one's prepared to think about.
People need to go to Amazon.com. We both got colds. They need to go to Amazon.com and purchase The Fiscal Theory of the Price Level and also Crisis Cycle, Challenges, Evolution, Future of the Euro. And I'll tell you why they need to do this. There's so much gold in there. And even the idea to understand the gravity of fiscal policy, I think is so essential. This idea that, if I raise rates, that can curb inflation without understanding that exacerbates the debt. And according to fiscal theory price level, that can cause inflation. So by raising the interest rates, you exacerbate debt. And as you exacerbate debt, unless you have confidence that future surpluses can balance that, it's inflationary. And that's a really interesting and important thing for people to consider, that raising rates could exacerbate inflation. Let's finish on that.
I give you an A+ for having gotten one of the most subtle and difficult concepts in there. I'll also advertise on my website, johnhcochrane.com, where you can get all sorts of free stuff, including updated chapters on fiscal theory and essays that make it very simple for you. And my blog, The Grumpy Economist, where you can find out about all this sorts of stuff in a lighthearted, entertaining way, and also free. I like to give away free stuff first and then hook people on the books. Like it.
Me too. Speaking of free stuff, go to cashflowbonus.com, like, subscribe. You're not a grumpy economist. You smile as much as anyone I've ever seen. Absolutely delightful. I hope I can have you back. I hope I haven't worn out my welcome.
No, it's been great fun.
And I can have you back because I'm just a C- old basketball player trying to keep my grades to be eligible to play basketball. That's all I'm trying to do. And I'm always out of my pay grade when I get to talk to the PhD. So Dr. Cochrane, thank you so much. If you just hold on just a bit so we can upload
Yep.
and I can properly thank you. You've been watching and listening to the Cashflow Academy podcast. We have a lot of fun. We try to make it simple and keep it real. Make sure you go to Amazon.com, purchase the Fiscal Theory of Price Level and also the Crisis Cycle. You guys know how I sell books. If you had a chance to take Dr. Cochrane to dinner, would you pick up the tab to be able to bend his ear for a couple hours? Of course you would. Well, you get a lot more than that in these two fabulously written books. I can't recommend them enough. They should be part of your library. Take care, everyone. I hope you enjoyed our conversation. We'll see you next time.